Now, back to Ticky.
Welcome back to Banking. A new report from former Public Service Commissioner Stephen Sedgwick has found that the banks are on track to meet their Royal Commission deadline for the overhaul of staff pay, which you remember was a really prickly issue. This is despite criticism, though, from ASIC yesterday, with the corporate regulator complaining that banks have been too slow in structurally responding to the Royal Commission, specifically when it comes to reviewing their fees for no service practices. So how should we assess the report card? Well, for more, I'm joined by CEO of the Australian Banking Association, Anna Bligh. Anna, welcome back.
Hi, how are you?
Good. Let's talk about the thumbs up that you got. And this goes back to Stephen Sedgwick's report a while ago, wasn't it, that banks really need to move?
So banks contracted Stephen in 2016 to have a really good look at this issue of how incentives might be, you know, motivating people.
So this is long ahead of the Royal Commission.
Yes, but so Stephen gave the report, said got to be a big overhaul. You have to break the nexus between, you know, people's incentive programs, bonuses, and direct sales targets. And it's such a big cultural shift, and it's such a big kind of change. He said you've got to have it all done by December 2020. So the Royal Commission,
for 3 years.
3 years.
Yeah.
Remembering we're talking, you know, more than 100,000 staff, and to really embed it. So the Royal Commission, when it looked at a number of the case studies, it expressed concern about how incentives might have rewarded the wrong behaviour, and the Royal Commission's recommendation on remuneration was that should fully implement the Sedgwick report, both to the letter and the spirit.
Yes.
So we're halfway through the process, and so the industry thought now is the right time to take another deep dive and make sure we're on track.
Yes.
Is it being implemented well, properly? Is anyone lagging? Are there things that we need to pick up the pace on? And it's very encouraging, I think, with such a big cultural shift that Stephen's independent report makes it clear that very good progress has been made, but for the most part banks are well on track to be.
So broadly, I mean, some would say, well, for heaven's sake, I mean, you know, of course it should be like that. I mean, you're saying that banks are retraining frontline staff to encourage a customer-first approach rather than a sales-first mindset. You know, if I'd asked, say, Ian Narev, you know, a year ago, or whenever it was, 18 months ago, he'd have come back and said, oh no, we've got a customer-first approach anyway. We don't have a sales-first approach. Well, clearly this is acknowledging that, you know, you did have a sales approach.
And that's what Sedgwick's report said in 2017. And I don't want to present this as the work is all done, because it isn't. More work needs to be done. And I know on the face of it, it sounds like it's, you know, might be a no-brainer, but it's not a matter of just saying, right, we'll no longer have sales targets. It's then, how will we assess your performance? And Stephen Sedgwick said you need to have a balanced scorecard that measures how well you serve customers, how well...
and more about the time it takes to serve customers.
Exactly, whether you're doing things timely, whether customers are having a good experience, whether they're getting the right outcome. So measuring, working out the best measures of that is not necessarily straightforward in every classification bank.
Also highlighted the lack of action on the mortgage broking remuneration side. That's still got a bit of work there to do.
That's certainly the area that Stephen's progress report pointed the need for more action and to move faster. However, he did acknowledge that the sort of remuneration issue has become complicated by recommendations from the Royal Commission, which
well, indeed, it might all change anyway.
And then the government's response to that and the opposition's response to that. So I think we need to see some of the dust settle after the election to see how those things will play together. So
coming back to the criticism that you got from the regulator this week, or the banks did, an update, this further review on how the banks are going with the fee for no service failures and remediation, and it was a very poor report card. Why is it so bad, Anna?
Well, I think the fact that these two reports came out on the same day, it actually gives you a sense of or within 2 days of each other, the size and the breadth of the reform and transformation process that is happening in banks. And like all big change programs, some things are moving a little faster than you might have predicted, others not as fast as you had hoped.
Now, why is this that? Because firstly, fee for no service was the standout atrocity, frankly, I would say, in terms of its size. And secondly, September last year, ASIC came out with its breach report, which was again a absolute roasting of the banks, talking about unacceptable delays, 4.5 years to identify significant breaches. I could go on. Now, given that they had the warning lights and then come Hayne and they say, ASIC, go harder, this further review has come up with another failure. I mean, what are you expecting ASIC to do with this now?
Well, certainly I wouldn't say for 1 minute that anything here is good enough. I think ASIC has sent a very clear message to banks that the sort of timeframes they might have once been able to enjoy on these sorts of remediation programs are a thing of the past. That ASIC is going to delve in and see what's happening, and if it's not good enough, ASIC is going, and I think that it sends a very clear message to banks.
But are they going to get, do you think, BEAR will come into action? I mean, if this sort of performance happens at one or more of the big four banks, can you see APRA, for example, implementing some sort of BEAR executive, docking pay or affecting bonuses, that sort of stuff, so that it really hurts?
Well, ultimately that's going to be, APRA oversees the BEAR regime, but it's only very, very young. And I'm sure they
could get a first outing over something like this, though, couldn't it?
I'm sure they'll turn their mind to it. One of the other recommendations of the Hayne Commission was that ASIC should also have some responsibilities on some conduct issues in the BEAR regime, and this could at some stage be one of the things that they might consider. But I think on this one it's important to recognise that ASIC's report does identify the scale of this project. The CEOs who appeared before the House of Reps last week indicated that on some of the remediation programs, and this is likely to be one of them, frankly, they were too slow for too long, but they have, and they didn't, as ASIC said, put enough resources into getting it done quickly, but that they have remedied that and the pace has picked up. But, it needs to go faster, and I think there's some very big learnings here about the time it takes is not going to be, that it's taken in the past, is not going to be tolerated in the future, and that means big investment in systems, big investment in compliance, and a lot of senior leadership attention and focus on progress reporting. Are we on track? Are we on track? And going back, that's what the Sedgwick progress report was. I didn't want to find out in November 2020 that we weren't on track. I wanted to know now.
Right.
We're lagging.
Right. And ASIC will pick you up if they're not.
Yes.
All right. Well, look, we will definitely you guys. So one thumbs up and one very much thumbs down. But Anna Bligh, we'll see how we go. Thank you very much.
Thank you very much.
Well, that's all for the show tonight. Tomorrow night, Australian Super C.